Hi, I'm Mike Cintolo, Chief Analyst of Cabot Growth Investor and Cabot Top 10 Trader. I'm here with your Cabot Weekly Review, and I'm recording this late Friday morning as usual. So, as I wrote in yesterday, Thursday's Cabot Growth Investor, I do think the market continues to provide more and more what I'm calling bullish breadcrumbs. We had the index is really not going down too much from the January low, despite war and commodity inflation and the Fed raising rates. And then last week we had positive divergence and new lows. And last week we had a very rare sort of thrust signal, so to speak. I call it a 4-day frenzy, just to come up with a silly name. It was basically 4 straight days of 1% gains in the S&P 500. Only happened a handful of times. And when you combine it with sort of a cousin indicator called the 3-day thrust, basically it portends very good things 6 to 12 months out. Now, with that said, number one, it's just one indicator. I do like these blast-off measures. They're rare and reliable. They've treated us well in the past. So I do think the odds favor the market has bottomed or could be in a further bottoming process. But in the next few weeks, it's not unusual after these signals to see the market back and fill, retest a low, or partially retest a low, so to speak. So we'll see how it goes. When you combine that with the fact that the primary evidence, the intermediate term trend of the major indexes, of growth funds, of individual stocks, that still hasn't yet turned green. All in all, we've put some money to work, but we're still holding a lot of cash and we're kind of just waiting for further upside confirmation in the market. In Cabot Growth Investors Model Portfolio, we had something like 75% cash 3 weeks ago or whatever. That's down to 55%. So we've been doing some buying, but I wouldn't say we're exactly cannonballing back into the pool quite yet. Okay. We'll see how it goes. There's some things to worry about. There's interest rates. Obviously the war's still going on, sanctions, this, that, and the other thing. But so far, the market's holding up pretty well despite all that. Obviously, it's come off its lows and it's holding those gains this week. So I think it's been a constructive week. From here, it's just a matter of taking it kind of step by step, day by day, and seeing if the evidence can continue to improve. If it does, we'll put money to work. If not, we'll hold our cash and watch our stops as usual. All right, let's hop on the charts as usual. I'm using a program called MarketSmith. You can learn more at marketsmith.com. It's a product of Investors Business Daily. So here's the NASDAQ. What I'm really cluing in, and you can kind of see here, I went over this the last couple of videos, kind of a bottoming process, positive divergence. Then you had this sort of 4-day frenzy. What I'm really looking at this point is this 25-day moving average to start to turn up. We're not really seeing it yet. Obviously, today we're down pretty healthy on the indexes as interest rates really pick up, so we'll see how it goes. Now, if the indexes kind of hang out here for another few days, next week, we'll probably get a green light on the intermediate term, but we haven't quite seen it. It seems to be flattening out. We kind of need to see it turn up. Similar story with the S&P 500. I also want to mention, the S&P here is above the 200-day line, but it's still like 75% of NASDAQ stocks and 55 or 60% of NYSE stocks are still below their 200-day line. So, there's still headwinds the market has to get through. I'm just saying that the evidence has gone from, horrible to better. And it looks like, at least we're either still in a bottoming process or have hit bottom. Same sort of thing here. The 25-day line just starting to turn up. We'd like to see it get a little bit ahead of a steam, and it probably will next week if the indexes can hang in here. Okay, and just running through them. This is the IWM. We actually use the S&P 600 small cap, but it doesn't update during the day here. You can see the 25-day line's flattened out. You'd like to see this sort of push higher here. Same thing with the mid caps. This is MDY. They've kind of been in these wide bottoming ranges, hopefully bottoming ranges for the past 2 months for the most part at this point. I'd like to see it sort of stretch higher here. 25-day line turn up, and the New York Composite, same sort of thing. It's acted very well of late. Oil stocks, commodities, financial stocks have done well. I'd like to see this line turn up. That would be kind of the next step to us. Would be, not just, don't get me wrong, I don't want to see this happen and technically get a buy signal. But if things can hang in here, especially if they extend higher, 25-day line turns up, that would turn our intermediate term model for the whole market positive. A little bit further behind them are the growth funds. They're not that far behind, but they're not quite as strong as the major indexes. So this is QQQJ. And just to let you know, we're kind of dropping off. I think we're dropping off this day. So next week we'll be dropping off these lower days into the invasion low from late February. So again, technically if we hang out here, we could get a technical buy signal, but what you'd really like to see is these things hold up despite the interest rates and all that, and stretch their legs next week or after a few days more of rest. And then that would kind of create an intermediate term uptrend. But so far, it hasn't done it. IPO fund, same sort of thing, back below the 50-day line. stretching lower. Same thing with ARC. Again, these aren't, ARC, I've said a bunch of times, it's the most extreme, but, hit the 50-day line, still backing off. So it's not like everything's just out of the woods. Some of them look better. We look at the Russell 2000 growth. This is IWO. But again, it's just kind of in this, bottoming range. You hope it's a bottoming range. You'd like to see it stretch its legs and get a buy signal. Okay, so if we do that, if we get that, we'd probably continue to put money to work, assuming individual growth stocks, which I focus on, are acting better, but we'll see how it goes, okay? So far, so good, but more work to be done. A couple of the ETFs I just want to mention. This is XME, and I mentioned this, thankfully, somewhere back here, I think. Two things. This is sort of a short-term, intermediate, long-term thing. Short-term, everyone knows commodities are strong. They've had huge runs. They're extended to the upside. If you've been trading them, you're making money. You're excited about it. All the news is good, fertilizer, and I agree. Long-term, I think when you look at this thing, this is XME. It's been out of favor for, take my word for it, it's been out of favor for years. You had the post-vaccine rally, and then it went nowhere for 9 months, and now you get this powerful upside breakout. I think that generally bodes well, although you can never trust these stocks farther than you can throw them because things can change so quickly. But just chart-wise, I do think that, the next pullback probably won't be the last pullback, meaning it will have higher prices. But short-term, just because we have highlighted a lot of these in top 10, don't be afraid to ring the register. I'm not saying if you own 5 of them, go sell 4 outright, but take a couple of partial profits, trail your stops, that sort of thing. Just realize they've had good runs, and if the news changes and some of the hot money leaves, something like XME, it could pull back. I think the fund could pull back 10% and still be above even as 25-day line. And obviously, some of the faster moving stocks could do that. So long term, or at least intermediate term, I do think the next pullback could be viable. Shorter term, though, if you have raked in some money, maybe ring the register a little bit and see how it goes from there. The other one I just want to mention here is TLT. It's not a great chart here, and I don't trade off bonds or interest rates. But listen, as a student of the market, higher interest rates, usually not good for the market, usually. Okay, and you can see it's really had an accelerated move down here. This is bonds. As bonds go down, rates go up. So TLT. Okay, you can see it's been 142 to 130, which is a pretty big move for long bonds. Actually, it's actually down to 128 here today. What I would say is two things. Number one, so far, okay, as I record this late Friday morning, the market is holding up pretty well. Even growth stocks are holding up pretty well given the recent moves up in the stocks. They're holding up pretty well given the rise in rates. And so maybe if we see, even if it's just like a relief rally, some bad economic numbers come up, something like that, maybe let's see if growth stocks can really get ahead of steam after that, So far, so good. But I would just say there's no question the trend is down here, which means the trend is up for interest rates. Nothing I trade off of, but obviously I'm just keeping an eye on it and keep an eye on the chart. We are stretched here. So what I am kind of interested is if we do retrace, how does the market handle that? Does it not care? Does it think it's really bullish? Let's see how that goes, okay? Heading into individual stocks, I'm going to start with a bunch of sort of commodity names. So this is Star Bulk, SBLK. One thing just as a total aside, I have noticed that some of these, like this one paid $1. I think it was $1 dividend for the quarter, which is pretty big for a $30 stock. After it goes ex-dividend, which I'm pretty sure this did, you have seen usually 2 or 3 weeks of sometimes these stocks kind of sloughing off. There might be some dividend chasers in there, just something to be aware of. Again, this is totally just anecdotal, but I have just noticed that looking at a few different oil stocks and some of these shippers and stuff like that. But either way, on the weekly chart, what's more important to me is just sort of the bigger picture. Nice consolidation here. Obviously, the business is good. You have this accelerating buying volume. And now you've had, 1, 2, 3, 4 weeks in a row of calm down. This week is very small range. You can see on the weekly chart, it has tested the 10-week line. I still think pullbacks are better for these names. If the group pulls back, this will probably pull back too. But if it can pull back controllably and maybe the 50-day line meets up, that might be an idea for you. NTR, Nutrient, I mentioned this last week. This is very much like XME. It kind of had this long consolidation. In this case, it was sort of a base on a base. It's almost like a flagpole here. You had a little bit of a shakeout for 4 days. I don't want to say a little bit. I mean, it was pretty sharp. It was probably 10% in 4 days. But now it's raced to new highs. My guess is, again, it's not just going to do this and go to $1,000. I don't think. So I hope not. I think it can pull back. If you pull back, maybe you get a tag up of the 25-day line, or you get maybe a 2 or 3 week cooling off period, which would be totally normal. But NTR is something that's on my watch list. Another one that's a little smaller and even hotter, if you can believe it, is Alpha Metallurgical. This is Met Coal. It's in top 10. And again, on the weekly chart you have, I'm not trying to call this some sort of pattern. It's had a huge run, but it had this sort of base in here. It's gone vertical, and now it's had 2 weeks of consolidation. Let's see, honestly, a third or fourth week in here might actually set up a pretty high potential, I wouldn't say high odds setup, but so far so good. But again, maybe pullbacks into the 25-day line, something like that, just generally speaking. Antero Resources, this is natural gas, but also natural gas liquids, which are really highly priced even compared to oil right now. You can see this breakout. This is kind of, some of these are a little fresher than the oil names. Breakout at the beginning of the month. You had your first pullback. Now, obviously, it's accelerated higher. See if pullbacks come. Civitas Resources, I wanted to mention this one because it is breaking out. Obviously, it looks good today. Usually, the later breakouts in a sector aren't the best plays. Sometimes they can work. Like in this case, Civi was sort of, I don't want to say left for dead, but it was really struggling here at the late February market sell-off here. This was the invasion. Really came up, kind of, I wouldn't say tightened up, but kind of flattened out, and now it's getting going. Sometimes these late breakouts, while the other oils have already run, not so much, but let's see how it plays out. It's pretty good volume today. It's obviously moving nicely. And then last but not least, on the commodity side, I just want to mention MP. This is rare earths metals, and you can see it is very, very, very choppy. I mean, 47 to 37 to 44 to 46 to 40, and then it breaks out this week. So, and longer term, you do have this sort of nice breakout. So I do like the look of it. But with these things, whether it's dips, small positions, a mixture of both, you got to give them loose leashes because some of these things could pull back 8-10% in a day or two and be totally normal, or at least not broken. So, but anyway, MP does look good. Good sales and earnings estimates. This one also showed up in top 10. On the growth side of things, a few names. So this is Car Gurus. I mentioned it back here. It went vertical on earnings, and it was up like 40%. But the market wasn't ready, and a lot of times these things are 1 or 2 day wonders. It goes from 50 back down to 36 in a few days, and then it bounced back up. What you'd like to see, you have this sort of vertical move. Sometimes what you see when the market's not ready or the stock's not ready, then they have this sharp pullback, then it bounces, now it's coming in, then you do, okay, and it's kind of the volatility will kind of contract a little bit. And that's kind of what I'm looking for. It's pulling in the 25-day line. It doesn't look like a horrible risk reward here. I'll leave that up to you, but you wouldn't mind seeing this kind of base out a little bit, put in a little bit of a firmer foundation. But so far, I still think it acts proper off that huge gap. Expedia and some of these turnaround names are like the, what are they, reopening 2.0 names. I just find it interesting because you've had these things that on the weekly chart with a few of these, it's kind of like, well, maybe it's going to break out here. No, it wasn't ready. Oh, here we go. No, wasn't ready. Oh, no, okay, now it's definitely ready. Nope, market pulls it back down. And then you end up having this huge shakeout down here at the market lows. And the volume here, while not, all-time epic, it was the highest. This is the weekly volume going back to January of 2021, so over a year. And now it's kind of obviously perking back up, straight back up, calming down a little bit. I mean, obviously it's still choppy on a day-to-day basis, but you can kind of see it's a little bit, short-term range bound. Let's just keep an eye on these. I have a hunch that some of these can work. Another one that looks even better is SeaWorld, Seas, S-E-A-S. Same sort of thing, except, excuse me, a little frog in my throat. Just kind of was bobbing between 70 and 55 for a few months. Tested the 40-week line a couple of times, big shakeout a couple of weeks ago. And just the action since then, I can't say the volume has been overwhelming. In fact, it hasn't been at all. Excuse me, I'm sorry. But the stock you can see is just smoke up a chimney here. It just seems like all the weak hands probably got wiped out. Not my favorite cup of tea, the turnaround things, but big earnings estimates this year, so I'm not complaining. I think I mentioned Lantham, LNTH. They make sort of imaging agents. It's a thinner trader. It's had obviously a big move, but it did have 10 times average volume on this breakout. That breakout was of this massive, 2 or 3 year structure, however you want to, measure it. It does have sort of this ugly day, but this sort of action to me is not, that unusual. Now, would it shock me if the market pulled back and something's up, because it's a thinner trader. No, there was a lot of volume yesterday, but I'm just sort of flagging it to keep an eye on it. It's on my watch list actually, or it's maybe a back burner watch list. But, if the thing can kind of pull back here, shake out, but hold up for a few days, that might just be sort of a shakeout and sort of a pause that refreshes. On semiconductor, a lot of semiconductors are still acting well, which is somewhat surprising to me. Now let's see, a few bad days and you're back toward the lows. I wouldn't say this has been the best bounce of all time, but just overall, you kind of have this more just a reasonable basing structure. I'm not going to give you sort of breakout levels, but it doesn't take a genius to look at some of these resistance areas. So just something to keep an eye on. And then a couple of bull market stocks. Blackstone, not ready for prime time yet, but I wrote it up in Growth Investor this week just because you kind of had this consolidation. Post-vaccine rally was very long and very smooth, and it did find huge support after earnings in, I guess that was January, early February. But, after this huge move, usually you need more than just kind of a few weeks down. And so far, it's taken another 5 or 6 weeks to kind of retest the low, hold above the prior lows, which is good, and perking back up, a little bit of buying volume. So I'm just kind of keeping an eye on it. Maybe this thing gets ahead of steam, or maybe the market pulls in a little bit and then it gets ahead of steam, whatever. But I think this could be just a sort of a normal consolidation that leads to higher prices. And sort of on that same front or similar front, I know interest rates affect this, but this is LPL Financial, kind of like Expedia or SeaWorld or whatever. It's kind of like, here's a consolidation. Oh, here's a breakout. No, that didn't work. Here's a break. No, that didn't work. Okay, this one's going to work. Nope. And then, it just kind of keeps, oh my God, this is never going to work. I'm just taking off my list. I'm not going to watch it anymore. That's what I did. And then I ran a screen a few days ago and I was like, oh my God, this thing bounced all the way back. After a big shakeout here at the market lows, you can just see, kind of like SeaWorld, it's just been sort of straight up here. Obviously, it could pull back here. I wouldn't say the straight down, straight up action is the healthiest. It's not the highest odds play to go buy it right here, but just in general, you're sort of flagging that strength earlier in the move. And just one more that I'm going to mention that's sort of, I guess, in the reopening 2.0 theme, but it still needs a lot of work. But one thing you do see, I always keep an eye on these IPOs. This is Airbnb, Airbnb, because a lot of times these things, they won't do anything for year. I think Baidu was it Baidu or Alibaba? It took years, and then all of a sudden it got going and it was a huge run. So you just kind of keep an eye on them. So here's Airbnb. It's obviously the leader in its field. Tried to break out right at the market top. That failed, obviously. Now you kind of have this double bottom base in here. It needs work. It needs to get strong. But, who knows? Maybe it gaps on earnings. It's quote unquote only 22% off its high. So it's not like it's, 60% down. And so if it can kind of get ahead of steam here, maybe this is sort of a fresh, nice looking launching pad for it. So just something I'm keeping an eye on. Back to the market, let's see how it goes. I am encouraged. I do like the 4-day frenzy, so to speak. I do like the new lows divergence. I do like the resilience in the face of a lot of bad news. But the intermediate term trend is still neutral at best. The longer term trend is, most things are below their 200-day moving averages. Not a lot of stocks are racing to new highs. There's still a lot of stocks hitting new lows every day. So there's more work to do. I think the market has probably done about as good as you could hope for in the last few weeks in terms of building a bottom and some things drawing lines in the sand and the 4-day frenzy and the so on and so forth. So I like what I see, and that's why we put some money to work. But we're still 55% in cash. So let's just see how it goes. Maybe interest rates are too big of a hurdle for the market. It needs more time to correct and consolidate. That sort of thing. Maybe something happens overseas. We'll see how it goes. So right now I'm encouraged. If you've been very defensive, especially with growth stocks, I think putting a little money to work does make sense, especially, on some pullbacks or some tightness. But let's just, let the market continue to prove itself on the upside before we get too crazy, okay? That's all the time I have today. As always, thanks for listening, and be sure to come by again next week for another Cabot Weekly Review.